biggest features of the week top down, at least in theory, are the European Union Summit in Brussels on the 17th and 18th of October and the International Monetary Fund's annual get-together in Washington DC on the 18th and 19th. The latter will provide the IMF's latest views on the global economy, as outlined in the always interesting World Economic Outlook documents which it publishes twice a year. Now, as for the EU Summit, the official agenda has got 3 points in it if you look at the website. Assess the EU's multi-annual financial framework and progress in developing it as per Finland's current presidency. The strategic agenda for 2019 to 24 and the European Council's 4 main priorities of citizens' freedoms, economic strength, climate-neutral policies and the promotion of Europe's interest on the world stage, and then foreign policy issues. Now, it seems fair to assume that somewhere in there there'll be discussion of Brexit and maybe talks over a potential deal with the UK ahead of the 31st of October deadline, which, under Article 50, is due to see the UK leave the European Union. Now again, it would be brave or foolish of me and dangerous for investors to try and second guess any of the possible outcomes here, so we'll move swiftly on to the corporate news. Now that's going to move into overdrive in the USA, where the next quarterly reporting cycle is due to start on Monday the 14th of October, with results from advertising giant Omnicom, airline United Continental and brokerage Charles Schwab. News flow is also going to pick up here in the UK, where we have a good number of trading updates, interim or final results due for release from large, mid and small cap names. They include Prudential on Tuesday the 15th of October, when an EGM should approve the plan to spin off fund management arm M&G. Minor BHP, real estate investment trust Segro and house builder Barratt on the 16th. Rentokil Initial, Unilever and retailer WH Smith on the 17th. And the London Stock Exchange and Intercontinental Hotels on Friday the 18th of October. But the company which could cause the biggest fuss in the week ahead might just be ASOS. The online fast fashion giant, which is the 4th biggest company by market value on the London Stock Exchange's Junior AIM platform, is due to publish its full year results on Wednesday the 16th of October. Its comments could have implications for the retail sector as a whole if recent history is any sort of guide. Now, as you can see in this first graphic, the share price has had a pretty terrible time of it over the past 12 months, falling from around £60 a share to just £23. Those investors who bought the shares sold last September at £56.85p by Denmark's bestseller, still a major shareholder with a big stake, well, they're likely to be pretty peeved. Anyway, the share price plunge is the result of profit warnings dished out in December 2018 and July 2019. So ASOS will be looking to avoid making it a bit of a nasty hat trick. Now, previous reasons given by Chief Executive Nick Baton for the trading alerts have included substantial investments in IT and new logistics facilities, operational issues at warehouses in America and Britain, stock availability, economic uncertainty and soggy consumer confidence, and to round off a long list, stiff competition and high levels of discounting. As a result of that lot, Mr. Baton lowered guidance for the full year to the end of August. Analysts will now be looking at 5 key points in the results. First, sales growth is now expected to be around 11 to 12% on a reported and constant currency basis. The analyst consensus forecast is revenues of £2.7 billion, an increase of 12%. In case Mr. Baton gives any forecast for the year just beginning, analysts are looking for 15% sales growth to £3.1 billion. Second, the retail gross margin is expected to drop by some 250 basis points, 2.5%. This graphic tracks the retail gross margin. It came in at 49.9% in the year to August 2018 and it ebbed to 47.4% in the first half. So the company forecast implies no further deterioration in the second half. Third, ASOS has forecast a pre-tax profit of between £30 and £35 million after some £50 million in restructuring and what the company calls transition costs. Now that compares to £102 million a year ago. Now, if there's any outlook from Mr. Baton, the analyst consensus forecast for the new financial year is a pretty big rebound to £63 million in pre-tax profit. Fourth, the capital investment budget's due to be some £200 million against £213 million last year. And finally, the company suggested that net debt will reach £100 million. That compares to a net cash pile at the end of last year of £43 million. All of the charts, by the way, only go back to 2012, as that's when the company shifted its financial year end to August. So that just to make sure that they're all comparable. Thank you for watching, and I look forward to seeing you next time.